my name's James, and today we'll be discussing the United Kingdom's economy, looking at their strategy and what's changed and what's going wrong. So we can see that in the early 2000s, a huge build-up in household debt before the financial crisis and a huge collapse since then. You might want to pay attention to this because it will be important later. Okay, so what is the main driver of the United Kingdom's growth? Well, it's been since 2000, household consumption by far. Over 61% of growth has come from household consumption in the United Kingdom. So you might want to look at how this has performed since the year 2000. So if we actually look at what's producing GDP in the United Kingdom, we can see that the tertiary sector has picked up around 70% of total GDP production. What this means is these jobs rely heavily on household consumption to fuel incomes. So as the share of manufacturing declines, you rely less on exports and more on household consumption to not only fuel incomes and disposable income growth, but also growth in general. All right, so now let's look at the main driver of household consumption, disposable income growth. You can only consume as much as you make at maximum. So let's have a look. So each year on average, disposable income grows by about 1.8% per year since the year 2000. The problem is that CPI inflation has gone up by about 2.6% per year since the year 2000. And that problem means that real disposable income growth after inflation has actually gone down by 0.8% per year. And if we look at utility price inflation, about 4.1% per year since the year 2000, we can see that incomes have actually gone down by about 2.3% per year. And what this translates to over a 25-year period is about an 18% loss to a 44% loss in your ability to consume, because more and more of your income or disposable income is just going towards everyday cost of living bills. And basically, if your GDP is reliant on household consumption and consumers are consuming less because of cost of living crisis, well, your GDP naturally tanks. We can also see that the cost of living crisis is not the only component driving household consumption down. There's actually a higher savings rate compared to the year 2000 of about 10%. This is one, due to higher interest rates, and two, due to people worried about the future. So now I want to bring you back to this chart here from the start of the video. You can see that prior to the 2008 financial crisis, household debt GDP growth exploded. And since the 2008 financial crisis, it's been collapsing. And you might notice it's similar to the collapse in GDP growth we've seen in the United Kingdom. And why is this household debt GDP growth so important to look at? Because in the 2000s, a lot of refinancing occurred, so citizens in the United Kingdom would refinance their house, take that equity out, and spend it in the economy, basically borrowed consumption. The problem is, after 2008, a lot of this consumption is being paid back, as people were choosing to pay down their loans or their mortgages, rather than refinance and take out a bigger mortgage, and then spend more in the economy, which basically has a negative effect on economic growth because consumption is down as you're choosing to save more. And this decision by UK citizens to not refinance and take out equity and spend or borrow consumption makes sense because interest rates are so high in the United Kingdom. Why would you borrow at 8%? You would instead just pay it down. You pay down your mortgage to reduce the monthly premiums. Because after the interest rate hikes, monthly premiums or monthly repayments have gone up immensely. So if you're going to borrow and refinance your house, your payment's going to go up very quickly. So what this actually translates to is we had a credit boost during the 2000s to disposable income and consumption because people were refinancing, taking out money and spending in the economy. Whereas now they are basically repaying down loans, and so it translates to a negative 2% drop in consumption because people aren't borrowing, they're paying down loans. Everyone knows about austerity and Brexit being a net negative for the UK economy, but what I want to draw your attention to is the LDI crisis of 2022 and really explore the fallout. As you can see, for the first time since really 2008, a huge net negative in foreign direct investment and also a huge net negative in portfolio investment into the United Kingdom. Basically, what happened during the LDI crisis is pensions have long-term liabilities, pensions that need to pay out, say, 30 years into the future, so they want to protect themselves against duration risk because they hold a lot of short-term assets, but they have a lot of long-term liabilities. So they created this thing called derivative, that basically insures them against long-term liabilities and helps them get long duration synthetically. The problem is that if interest rates go up substantially, you got to pay out cash premiums or margin calls, and the only way to pay out a cash or a margin call is to sell gilts, which further amplifies interest rates and causes massive problems because now you need to sell more cash, pay out more margin calls, and the feedback loop explodes. And this caused about a 45% drop in gilt prices across the board. And this is a big problem because now British pound tanks and everything starts to go wrong. We can see that prior to the LDI crisis, gilts were considered by international investors as stable, but it quickly dropped off during the crisis. And what actually happened is investment abroad or investment by UK pensions stopped investing in UK gilts and started investing abroad. And this caused the first swing in portfolio investment in really the last 20 years. Also, when interest rates spike like this, it increases the WACC, or the weighted average cost of capital. So international investors will look at the United Kingdom as unsafe, and that's why foreign direct investments in the United Kingdom has dropped off very quickly since the LDI crisis. And we can see here, since the fallout of the LDI crisis, a huge drop off in foreign direct investment or net foreign direct investment into the United Kingdom, and it actually swung negative if we factor in all of the factors like debt, foreign direct investment, retained earnings or invested earnings. It actually went negative for the first time since 2008. So why is looking at the net foreign direct investment inflows into the financial account and portfolio investment flows into the financial account important? Because this is what finances London. It allows the United Kingdom to run persistent trade deficits and primary income deficits. If this financial income deteriorates or reverses, it's a big problem and it's worth looking at. And if you like this video and enjoyed it, I encourage you to watch next my United Kingdom balance of payments visualized, and then my breakdown of the United Kingdom's balance of payments each chart. Thank you for watching.